about this a little bit yesterday, but I'll go over it again quickly. Your gross pay is your salary before your taxes and deductions have been taken out. So it's all the money you earned. Your hourly times your number of hourly or your salary. Your net pay is what you actually take home. It's after the taxes and any deductions have been taken out, and those deductions can be, of course, tax, income tax, Social Security tax, and Medicare will come out of every check. And then maybe health insurance, if you have it, might be deducted, retirement, you know, any of those kind of things that you pay for out of your paycheck come out, and then whatever's left is your net pay. It's your take-home pay. Your paycheck or pay stub has to include legally all of this information. It has to have your gross pay, it has to have your net pay, and it has to list itemized every single deduction that comes out of your check. So FICA taxes, federal income tax withheld, and then if you have, I don't know, 14 different deductions for different insurance and whatever, it has to list all 14. Your W-4 is your federal income tax withholding worksheet that you fill out when you begin a new job, and you determine how many allowances you're making. And an allowance is, you're saying that when I file my taxes, I'm going to be claiming this many people. If you look at this, here it's a worksheet. It's a personal allowance worksheet. You enter one for yourself if nobody else can claim you. You enter one if you're single and only have one job, or you're married and you only have one job, or your wages from a second job are $1,500 or less for the year. So at that point, you're claiming 2, even if you're single. Enter 1 if you're married. Enter a number of dependents you have, so 1 number for every kid. 1 if you file head of household. 1 if you have at least $2,000 of child or dependent care expenses, so that's daycare, or if you're paying for, like, say, an elderly parent to live in a nursing home, that kind of thing. And then there's, if you're going to make less than $65,000, you can enter 2 for each eligible child, and everything. So when you fill this all out, you get this number. And this number is the number of allowances you're making. Now, what this does is the higher this number is right here, the less money they're going to take out of your check for taxes. And so some people go, well, that's awesome, I'm going to have more money. The higher this number is here, the less money they took out of your check for taxes. You're going to owe what you owe at the end of the year based on your income and your exemptions. And when we go through the filling out the form, I'll explain all that to you. If they did not take out enough money because you claimed too many allowances, that means you owe the IRS a big old fat check for your taxes. The safest thing to do is to claim less on the W-4 than you're allowed to. You're allowed to claim 2 if you're single with no children. Claim 0 or 1. 1 is counting as yourself. But see, you're allowed to claim 1 for yourself and 1 if you're single. So you're allowed to claim 2 if you're by yourself. Don't do that. You'll owe money at the end of the year if you claim 2. Claim 1 and you might break out even, or claim 0 and you'll probably get money back. Because the lower this number is down here, the less money they're going to take out of your check. Or sorry, the lower the number is, the more money they're going to take out of your check. The more money they take out of your check, the more money you've got sitting in that I've paid this many taxes account. If you owe less than that, you get it back. You want to break even or have more money in there than you owe. You don't want to end up in a situation where you didn't pay enough taxes throughout the year and now you have to come up with some money to pay the balance of the taxes that you now owe. That's not a good situation to be in. Yeah. Your withholding taxes are the taxes that are withheld from your paycheck, and they're applied to your income tax bill when that is calculated after the end of the year. The W-2 is what you get annually from your employer. Looks like that. And the W-2 is a summary of all income and taxes that were paid to you from your employer and taken out of your paycheck. And if you have more than one job, you'll get more than one W-2. You'll have to get one from each employer. And then a 1099 is the form that you get for non-employment income. So you're not an employee. You may work for someone, like, okay, so I'm an independent contractor for another school, but I'm an independent contractor. I'm not an employee of that school. I work on a contract basis. They assign me a class. I teach that class. I get paid for that class. And then if they like what I'm doing, they'll assign me another class kind of thing. But I'm not an employee. They don't take taxes out of my check. Okay, so I get a 1099 for that. So all independent contractors will get a 1099. Unless you're hired by a private person, they might not do that. Bank interest, stock dividend, payments, things like that all get reported on a 1099, and no taxes have been taken out. If you are, let's say you're an independent contractor and you're working for individual people, maybe like you're a sort of like a handyman and you put in fences or build decks or just random kind of stuff like that as a contractor. The individual people that you work for or that hire you to do these jobs are probably not going to give you a 1099. Legally they can. They can go online and fill out the information and give you one, but most people don't do that. You are still responsible to pay taxes on that income legally, so you have to keep records of what you've made yourself, and you have to, for tax purposes, all taxes, you're supposed to keep records of all of your files for 7 years. So if you've got income that you don't get 1099 or W-2 for, you're supposed to keep those records for 7 years with your taxes. After 7 years, you're allowed to throw them out. Barbara started a new job and wants to verify that her net pay has been computed correctly. Okay, her gross minus deductions equals the net. Okay, so her gross is $269.75. FICA was 6.2%. Okay, FICA is Social Security. And then Medicare is 1.45. Then she has the federal withholding of $47.51. She had state income tax. Whenever you see that withholding, that's income tax. Okay, so this is income tax. She has retirement of $9, disability insurance of $256, medical is $12, and dental is $6. Okay, so these are her deductions that come out of her paycheck. And we have the dollar amounts on all but these two, so we have to calculate these two. Okay, so FICA is 6.2%, so that's 0.62 times her gross income. Okay, so that's $1,667. And Medicare is 0.0145, so 1.5% of the same amount. They both get calculated on the gross, not, oh wait, I lied about the FICA. I typed in 268 instead of 269, so that's wrong. It's 1672. And then the Medicare is 391. Okay, so back here. And then I'm going to go ahead and total up all of her deductions. So we've got 1672 and 391 are FICA and Medicare, and then you have 4751 in federal income tax, 1662 in state income tax, $9 for retirement, $256 for disability, 12 for medical, and 6 for dental. And her total deductions are $114.32. Those get subtracted from her gross pay. So her paycheck is going to be $155.43. Okay, so we have Lorna's biweekly pay stub. So this is every 2 weeks, which is $26 per year. Okay. Assuming that her salary and deductions remain the same throughout the year, how much will be taken out of her total annual gross salary for federal and state taxes? Right, so federal taxes and state taxes. Okay, this column, the amount, and this is the year-to-date amount, if you haven't ever seen that. So this is for per paycheck, and this is the total that they've taken out for the whole year so far. So since they're taking about $1,000 a month, and this is $7,000, we can assume that this is like, well, this is not working at all because this is March. I don't know. I was going to say it's like July, but maybe she made more in earlier months or something. I'm not really sure how it worked. But, so we're going to take her federal tax, and we're going to take her state tax. We're going to add them together. Okay, so she paid total tax per pay period. And we've got 26 pay periods per year, so I'm going to multiply that by 26. And she'll pay about $33,341.36 for the year. And before you feel too bad for her, she is making like $4,600 a month. This form here is the e-file form. So the employers are sending their information to the IRS electronically, and the IRS is creating these forms for them. They don't have to use this form. This particular form, they can use a different, but it'll look basically like this. I mean, there are some variations, especially from year to year. People decide that it would look better if this box wasn't shaded and, you know, this was moved over to the left or something. You know, they do make changes. But the information will be the same. So you've got wages, tips, and other compensation. Okay, this is taxed compensation, not anything that would be on a 1099. Okay, then you have the federal income tax withheld. Then you have something called Social Security wages. You have Social Security tax withheld. And then there ought to be some money here, and there ought to be some amount of money here as well. But this is just not filled out all the way. Okay, because the Medicare gets withheld. Down at the bottom is the state. So this is all federal. And down here is state and local. Okay, now every state has federal income tax because it's federal, right? Some states have state income tax, some do not. More do than don't. So out of the 50 states, more of them do have a state income tax than don't have a state income tax. So we're very lucky to live in a state that does not have a state income tax. We pay less taxes that way, in theory. Yeah. So that's the state. Here you have state and state, but then see how you have local and local? Local is county. So some states that have a state income tax also have counties inside of them that have a county income tax. Yeah, so you're paying 3 levels of income tax at that point. Now, on the plus side of this, if you pay state and local income taxes, those are tax deductible on your federal income tax. So whatever money you pay in state taxes comes out of your federal taxes. So it lowers your federal taxes. So it kind of balances out in that way. Okay, so how much did she pay in taxes? We've got federal tax. We have state income tax, and we have local income tax. So this person paid a lot. Sorry, my 4 looks all stupid. I'm going to go through some of this other stuff here too. You have dependent care benefits, and here where it says non-qualified plans. Then you have box 12, A, B, C, and D, and then box 14 is other. There are other deductions that get listed on your W-2 because of tax purposes. So for example, a flexible spending account. You know, we talked about that, where money comes out of your check and to pay for health care. A flexible spending account money gets listed on your W-2 under other. Yeah, under other. Retirement plan, and money that has been taken out of your check for retirement gets listed on here as well, because the money that gets listed on here changes your wages for income tax purposes, because flex account money, you know, those flexible spending account for medical, come out before taxes. Retirement money comes out before taxes. And so what happens is you'll have, in that case, these 2 lines will be different, because the Social Security wages is your actual income always, because you get taxed for Social Security on your complete income. There's no deductions involved. This wages, tips, and other is what you got taxed on. So this line can be smaller than this line, and it'll be because of retirement deductions or flexible spending account deductions or other kinds of deductions that come out pre-tax. Yeah. If you have pre-tax deductions to pay for your dependent care, like that's another kind of a flex account, that would be line 10. If it's just a medical account, it usually goes in 14, and other like union dues, if they come out pre-tax, if you belong to a union, that usually goes under here. Charity things that come out of your paycheck, if your employer works with the United Way or something like that. Amy works for Pound Ridge Financial Planners. Her employer uses an electronic e-file, W2 form as shown. And we want to talk about what accounts for the differences between this box and this box. Okay, so, well, and also this box. And that's what I was just talking about. These are her taxable wages. These were her total wages. Okay? So if we look at this, okay, so her taxable income is the $78,900. So $78,900 is what she was taxed on. Okay. The $92,100, her Social Security, is the total amount that she earned. Okay. When we look at this line here where it says E, this is a retirement contribution. It is not taxed yet. Retirement contributions don't get taxed when you put it in. It gets taxed when you take it out. So you don't pay tax on it now, but you'll pay tax on it later when you actually use it. And then you have line 14, which is other, and it says CAF 125, $1,000. Okay, this is a medical spending account. So it is also not taxed. Now this medical spending account, the flex accounts, they're never taxed, ever. The thing with these is, if you take the money out of your check and put it into a flexible spending account for medical purposes, you don't pay taxes on it. But you cannot claim any of those medical expenses on your taxes that you use that account to pay for. And if you don't use it by a certain deadline, usually right after the first of the year, so you start in January, it ends in December, and you have until like right after the first of the year of the next year. If you haven't spent it all, the government gets it. I mean, if you have, like, let's say you have a flexible spending account that you put $1,000 into over the course of the year, and you spend $650 of it, and you don't hit the deadline, and you don't spend the other $350, the government now takes your $350. It's gone. Flexible spending accounts are a use it or lose it proposition. You don't pay taxes on it, but the cost of it is that if you don't use it, then the government takes it in exchange for you not paying taxes on it, kind of a thing. It comes out of your check. So it's money that, like, if you make $100 on your paycheck and you put $20 into the flexible spending account, you'll only pay tax on $80. The $20 goes into a special account that you can only use for medical or dependent care. You can use it for daycare for your child also. So, yeah, it's really good for somebody that has set medical expenses that they know, I'm going to spend this every month. Like I have medications or I have doctor's appointments that I have to go all the time. Or if you get a new pair of glasses every year and you know you're going to get a new pair of glasses, put that much money in there. Yeah. Yeah, there's dependent care and medical accounts. There's two separate accounts. Right. But you can have both or one or the other.
And does the employer have to offer that?
Yes, the employer has to offer it. Yeah. So here, if we take this 12,200 and we add 1,000 to it, the things that were not taxed, and then we add that to the lower end of the income, we can see that we now get the other income. So the difference between this income and that income is that this is after pre-tax deductions. And this is the total income. So Social Security and Medicare get taxed on your total income, period. But your taxable income for income tax can be reduced because of specific allowed, like a retirement plan or a flexible spending account, or we were talking about some union dues, things like that. And anything that's going to lower your income and change this number to be different than that number is going to be listed in here, in this area. Now again, so tax-deferred contributions are contributions into allowable types of accounts, usually like an IRA or a 401k or a cafeteria plan or a flexible spending plan, that are deducted from each check before the taxes are calculated. Now they're tax deferred, and defer means to put off until later. So if you're talking about your retirement plan, you don't pay tax on the money now. You pay tax when the money is taken out of the account. So when you retire and your IRA, and you roll the money from your IRA over into like a regular bank account, then you pay tax on it. Okay? A cafeteria plan is a general name of an account that you can take money out of your paycheck pre-tax for certain types of things, medical, dependent care, things like that. And the money, like I said, it can only be used for certain types of things, and the money is not taxed. Now, the cafeteria plan in and of itself does not stipulate it's a use it or lose it kind of a thing. That is a flexible spending account. This is a specific type of cafeteria plan. Most of them are these. Okay, so most of the cafeteria plans around today are flexible spending accounts. The money goes into an account, and actually you can get like a little Visa debit card for the account, and you can spend it at the doctor's office or on your daycare or whatever. Or you can pay for, like, say you pay for daycare at the end of the month, and then you get a receipt, and then you send it in, and then they send you a check they reimburse you. The problem is if it's not spent by a certain date, it is lost. The government claims it. And that date is generally, again, right after the first of the following year. So if your flexible spending account started in January, it ends in December, you usually have until like right around February to spend it. The dates, the deadlines depend on who the account processor is, but it is definitely before April 15th. It'll always be before April 15th, usually though not that long out. The other thing with these, interesting fact, prescriptions are covered, medical visits, like doctor's visits and stuff, dental, vision. Not most over-the-counter medicines. However, does cover Band-Aids. So if you ever have a flexible spending account and it's getting to the deadline and you got like $30 or $40 left in there and you just don't have anything to go do, yeah, just go buy a bunch of Band-Aids. They don't go bad. You donate them to somebody that needs them, a shelter, or, you know, Africa, you know, whatever. Band-Aids, I mean, you never run out of Band-Aids. So it does cover Band-Aids. It does not cover cosmetic procedures. You cannot use a flexible spending account to get prettier nose or something. Like, it's only for medical. Yeah, it's for medically necessary procedures, not elective procedures. Don't recommend it. Yeah. Okay. Any questions? Here's our 1099. Now you'll see here this was for royalties, but you'll see there's no taxes listed on here. It's just income. Okay. We already talked about what 1094. Homework.